Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. Hope everyone had a good weekend. It's Monday, it's the 9th of January. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com. Just going to bring up the high risk investment warning. I've got two monitors, so I'll try and look at the camera as much as I can, but if I'm not looking, I'm looking at the other monitor. Can I just confirm that, can you guys hear me, see me, and see the screen? You should have the high risk investment warning in front. Just double check, please. Okay, excellent. All right. Morning, Joachim, Howard, Shadrach, Anna. Nice to have you on the webinar. Thank you, everyone, for joining. And just bringing up the market commentaries disclaimer. What we'll do is we'll just look at market scope and trading view. We're going to start off with trading view. I'm going to bring up this chart over here. This is the real rate. This is the real rate, and you can see that it's got a, let's just put an arrow here. It's come down heavily on Friday. This was after the jobs report. And then you can see that this is the US dollar. The US dollar's come down heavily as well. This is very interesting to me because technically speaking, let's just get rid of these arrows. Technically speaking, we have a continuation pattern here. So you can see that this looks like a, and we've pointed it out previously, right? That this looks like a flag. There we go. Looks like a flag. Looks broken out of a flag. Hamas. And if that's the case, okay, here's the flag pole, and target here. I'm not going to put much relevance to the target. What I'll say is that a flag is a continuation pattern, so it looks as if this is a flag. If it is, lower rates. Make of that what you will. The Fed is talking up rates. The market has a parabola in terms of the Fed funds futures. June this year, it sees the terminal rate, and then the Fed funds futures actually seems to indicate cuts. All right, the Fed officials say there's no cuts this year, but we can see that there has been a breakdown. Now, what's interesting to me is the correlation coefficient, which is at the bottom. It's been very robust for most of 2022, since the second quarter. But what's happened here is, as we had this flag, let's call it a potential flag, charting, the dollar didn't follow the rates up. The reason it didn't follow the rates up is because it's not the only influence on the US dollar. The US dollar will be influenced by spreads to other fixed income markets, and really on a relative basis, even though the real rate on the US side was increasing, on a relative basis, it was not enough to keep to pull the US dollar up with it. So that in effect broke the correlation coefficient somewhat. But if you take a look, Friday's data seems to have actually moved it back to a positive correlation. Now this is still a very low correlation, but if it builds and we get something potentially meaningful, on the correlation coefficient side, then we will potentially get the flag pattern affecting the dollar. In other words, if the flag is in fact bona fide, it's going to pull the dollar down with it. So let's build a case around that. The whole idea behind the rates is inflation first and foremost, and the sticky inflation seems to have started moderating. We've looked at the median CPI previously. Besides that, what about the wage inflation? All right, so let's take a look at this on a couple of levels. So the first thing I want to bring up here is the participation rate. The participation rate's ticking up. What does that mean? It means that there's more people in the job market. If there's more people in the job market, there's a higher supply. If there's higher supply, that seems to cap the wage inflation because there's an excess supply. Number one. Number two, let's take a look at initial jobless claims. So we look at the initial jobless claims. All right, so initial jobless claims here are not showing any warning signs. No warning signs here, right? Okay, let's go through to the continuing. Okay, continuing. So these are the people that are now continuing to claim. There's trouble here. This is kicked up. You've got a trough peak, higher trough, higher peak. It's above its 3-month moving average. So there are people that are on the dole. Effectively, they can't get off it at the moment. So this is ticking up. So we've seen participation rate, so there's more supply. We've seen continuing claims ticking up. There's more supply. Okay. And what else do we have here? We've got, let's put this in, United States hours. Let's see if this picks it up. Average weekly hours, let's bring that up. Okay, and look at this, look at the average hours coming down. Okay, now let's throw in, so Howard's mentioned what Goldman's has announced. So Goldman Sachs has announced that they're laying off 3,200. Okay, Amazon last week announced that they are laying off 18,000. I'm not sure what the severance is going to be for Goldman. I think the severance for Amazon is about 6 months. So there's a buffer for 6 months. So we're not going to see that reflected in the series for 6 months. Okay, but it's there. There's a hidden element to the weakness in the unemployment data. So you can see that the job market's not as healthy as the media is telling us it is. Okay, they're focusing on lagging data. They're focusing on the unemployment rate. That lags. Okay, lags. So the idea here, they're focusing on JOLTS data. That's lags. JOLTS data lags. Okay, so this kind of data is saying that there's some cracks. Okay, what's it like in Europe? Is it similar? I'll need to do some work on that, Howard. I can't tell you offhand, but I would suggest that we can probably use this as a proxy, because it's kind of if the United States sneezes, the rest of the world catches cold. Okay, so the idea here is the Fed is terrified of a wage spiral. Okay, well, if it's terrified of a wage spiral, there are elements to suggest that is unlikely. Okay, so that being the case, you can see how the market has started discounting in the lower real rate. Okay, so if it's discounting in the lower real rate, well, take a look at this. If I have to bring up on the baseline here, we've got the US dollar. This is the 4-hour charts. falling heavily. Euro, US dollar, pushing up. Pound, US dollar, pushing up. Aussie, US dollar, pushing up. US dollar, Canadian, pushing down. Inherent weakness in the US dollar. Bitcoin, pushing up. US dollar, Swiss, pushing down. US dollar, Japanese yen. Okay, this one, just be careful, US dollar, Japanese yen. There's influence here. There's manipulation here from the Japanese authorities. So I'm going to move over that. DAX moving up beautifully. Dow Jones moving up beautifully. Oil dropping. That's another suggestion that inflation, this is from the cost side. Okay. Gold to the US dollar, pushing up. Again, the influence of the US dollar here being felt across the board. Let's go ahead now and just take a look at our day trading, a big one in our day trading layout. I'm going to go through to DAX first. Okay. And all right, so the DAX actually, this is interesting. It's pushing down at the moment on our fast stochastic. All right, it seems to be pushing into the middle, which is our neutral area. So I'm a bit surprised here. I would have wanted the fast stochastic to be pointing up. So we're going to go through to euro now. Let's see what the euro is offering us. Okay, so the euro is pointing up nicely. Euro's pointing up nicely. Let's take a look at this on the hourly chart. Okay, so it's in the zone 1. All right. So its zone is synchronized. The zone is synchronized with the daily, but there's a problem here. Okay, the fast stochastic has on the hourly has dropped below 50. So if we drop below 50, that's our second check. We don't quite have our checks in order here. Again, DAX suggesting a little bit of caution to start the week. Euro suggesting a little bit of caution to start the week. Not surprising, if you take a look at the RSI and the hourly, it's heavily overbought. It's heavily overbought. So we're just going to have to wait for the markets just to probably resolve some of this froth. This froth here seems to be fairly heavy. Let's take a look at a few others. Take a look at cable. Okay, we've got a similar situation here with cable. In fact, cable's hooked down. Cable's hooked down. And we've got the a big one, stochastic, pushing into this bearish area below 50. So we're going to just have to wait for the froth to work itself out. So see, that's the froth. I'm going to look at one more, which was the Aussie. The Aussie actually looked really good after Friday's job data. I would suspect there's going to be froth there as well. Okay, and you can see here's the froth working itself out. Okay, there's the froth working itself out. So we're just going to have to wait for that just to normalize. Once we've got that normalization there, we can take a look at it again. Effectively, let's just summarize what we've discussed this morning. It looks as if the jobs data has effectively reconnected the greenback, with the real rate. Okay, but the day trading layout just suggesting a little bit of froth that needs to clear. So just a little bit of caution in the air. All right, I think we're going to stop over here. If there's any questions, please go ahead and type those in. Any questions? Please go ahead and type those in now. All right. Have a good day, a good evening ahead. Let's take a look tomorrow, see if the charts have cleared themselves up. Thanks very much, guys.